Welcome back to Investing in Trading Live, sponsored by Trading Academy. As always, I am your host, Josh Lilquist, with my good friend and my good pal, Mr. Al Connickson, on the old radio waves. Make sure to subscribe to the podcast. I mentioned earlier, the opinion out there is we have the number one financial show in the metro area here. But I want to make this the number one global podcast on the financial markets. Make sure to follow and subscribe to the podcast on Apple Podcasts, iHeartRadio, Spotify. We're actually on probably 20 different podcast sites. Wherever you find your podcast, go to Investing and Trading Live. In the last segment, we covered many topics on more of the income side of things, odds and probabilities. There's no secret sauce to trading and investing, but how to have a strategy that's designed to build longevity, not just a buy and hope strategy. And then we had a lot of people texting in. Congratulations for those of you that have texted in for that free investing class that we do here locally at the Academy here in Bloomington and in a city near you. We're doing a campaign all across the metro area to make it easier for you to come and get started in the financial markets. Simply just text the word investing to the number 210-210. If you did miss seats for that, text investing to the number 210 right now. You get a text back right away, and you will just click the link and follow that text, follow that link to our landing page, and you can pick your own time and date for the class. You were alluding to it towards the end of that last segment about making emotional decisions in the markets. And I think a lot of people, especially in their retirement accounts, because I want to discuss retirement accounts in this segment, Al, they feel they don't have the confidence to actually make those decisions because you're told to trust your gut, like you said. Well, think about this for a couple seconds. Have you ever been making a financial decision about anything in life? Buying a home, buying a shirt at the store, getting a nice dinner at a nice restaurant, or making a decision in your financial account. And you get those butterfly, that's a tough word to say, butterfly feelings.
For some people,
yes,
apparently it is.
But some people do when they make decisions for any topic. They get that butterfly feeling in their stomach, which means that turns into an emotional decision because that's what happens. Now, you need to eliminate those emotions in the financial markets, but how you do that is with a step-by-step approach in the markets. You mentioned earlier, and Peter Lynch even said it, have an entry point, when to get in, when to get out, and have those set before you even get in that investment or trade. That eliminates that emotion. That eliminates that butterfly feeling in your gut. Now you're not making a gut decision, or you're not doing what your gut says. You're doing what a strategy that's been built over many, many years says. You're doing what a strategy that has odds and probabilities says in your favor. I want you to talk about how having a plan is so important in a retirement strategy.
Well, that's a great point. Most people don't have a plan, or if you do have a plan, it might have been something that was put together maybe years ago. Probably that plan, if it was put together by most advisors, is based on data and strategies that were really designed for investments 40 years ago. It's not necessarily keeping up with what's going on now. I mentioned before that if you have an advisor that doesn't have a protection plan in for you, if there's no risk management strategy, that's a problem. If you have an advisor that doesn't have a profit goal for you, and that profit goal shouldn't be at the end of 10 or 20, 30 years, then there's going to be a problem. We look at 401ks. Everybody has been conditioned to believe that that is the secret sauce to being retired successfully, is just put money into a 401k. Most people will tell you they don't even know it's in their 401k. They put money into it, and basically it's put on cruise control, so there's no management there, there's no protection, and there's no way to really take profits on a shorter term basis. And what we have found basically from 2020 to 2021, 22 I should say, that the average return for the average investor has been closer to 3.6%. And when you look at inflation on top of that, or if you have any kind of fees that are taken out of your accounts, that pretty much puts you at break even to maybe even a real loss over that time period.
Let me ask you a question there, because you're seeing, and I've met with some people that say, I got some good gains in there. I'm putting money in it all the time, and it's going up.
Sure. Mm-hmm.
Where is that gain coming from? A lot of it is the contributions.
Sure.
So it's kind of tricking people in a way to feel they're getting gains. It's teaching people how to save, which is a great thing. But if the investment isn't really showing any opportunities, which is kind of what you're alluding to.
Yeah, so there's really three components to the movement of your 401k or your employer-sponsored retirement plan. One is the actual return or the performance of the portfolio, but the other two are your contribution and your employer's contribution. And remember, when you go into retirement, two of those three are gone. Your contribution is no longer there. Your employer's contribution is no longer there. And to be honest with you, a good part of what you've seen as growth in your 401ks over your working years has been those two components. The actual performance of the underlying of your portfolio itself has been very mediocre, and that's just kind of that's what you're going to find in most things, most components of 401ks. They're mediocre kinds of investments, and they really are not taking into consideration the risk level and the profit potential that we talked about.
So I think part of some of that reason, you're seeing people that are in mutual funds, and which can be devastating for retirement accounts. Is that part of the problem too? Is there a lot of fees to those?
Well, if you consider the fact that the fees, very conservative fees, if you look at, let's just look at 2%. If 2% is taken out of your retirement account, and typically that would be maybe mutual funds or whatever the investment asset is that you're in, 2% over the course of your working years could cost you 50 to 75% of what you could have.
Just because of the missed compounding effect,
It's
right?
Missed compounding, right. It's kind of like negative compounding. If you have, let's just say that you put $50,000 into, and I'm sorry, let's just say you put $10,000 into a mutual fund and you let it sit there for 50 years at 10%, the individual components of that mutual fund should be about $1.2 million. Mm-hmm. That's a pretty nice return. But if 2% is taken out every year, so that every dollar that's taken out is no longer there compounding for you, maybe growing to be $10,000 or $20,000, it costs you about $700,000, and that's at 2%. Is 2% high? Is that 2% low? Well, if you can Google this, but here's what I've found. On a non-taxable account, like a retirement account, the total cost is closer to 3.17%, and that doesn't include advisory fees or what we call soft dollar fees, so that number is low. For your taxable accounts, that number is closer to 4.17%.
And what is that? Oh, sorry. And what is that source that you're getting that from?
That is from...
is it finance.com?
It's from
Yahoo?
Forbes. It's from Forbes.
Forbes, okay.
Yeah, it's a report that came out from Forbes, and they talk about the different components. There are components that are taken out of your retirement account that you will never see. You don't even know they're there. There could be advisory fees, legal fees, soft dollar fees, revenue sharing fees, administrative fees, transaction fees, as many as maybe 17 different fees, the majority of which you'll never see.
Yeah, that's important to know that these things that we're kind of showing to you, they're not, we're not just making this up, but they're coming from Forbes.com.
Correct.
A reputable source on the financial markets. Now, you mentioned something I want to go back to real quick, because this ties into what you said at the beginning. You're in a strategy that maybe worked 30, 40 years ago. That's kind of how things worked back then. Well, things aren't the same, and the markets aren't exactly the same as what they were. That's very similar to athletes these days. You look at athletes these days, whether it's soccer, football, basketball, baseball, they're just different. You look at a basketball player, they look like me back in the 50s and 60s and 70s, right? But I feel like I'm in good shape, but we'll leave that to the imagination to the listener. But there's much more tools they can use. There's things for physical therapy. There's things to reduce inflammation, and that's a big thing. There's things for recovery that the athletes that are using now, they didn't have available back then. So things are different now in the financial markets. That's why you need a strategy that's designed for now, not what they did and used 30, 40 years ago. I want to kind of challenge everybody, as I mentioned earlier. Call your advisor or your broker and ask them what type of strategies were they putting people into 20 years ago, 30 years ago. And if it's the same exact thing, you might want to think about what are the other opportunities you have. What can you do in the financial markets? We introduced you to a lot of these strategies. And like I said, I'm not trying to bash people. It's the industry. The people are great people, and they make you feel like they're great. They give you a Christmas card every year, maybe send you a birthday card because they want to make sure they keep you as a client. So the people are great. They're phenomenal. The industry is the problem. To be introduced to the strategies and techniques to do more, to have more opportunities, to have different things, how to have odds and probabilities. Simply just text the word investing to the number 210 for 2 seats for an investing class about those retirement accounts, how to have more opportunities at retirement time. Text investing to the number 210. Coming up next, we got a couple more things to cover on income strategies and wealth strategies. This is Josh and Al. We will be right back.